All right, team, I got a great module today. We're going to talk about cost, volume, profit analysis, which, as it sounds, focuses on cost, volume, and profit as part of the company's budgeting or forecasting processes. So we're going to focus on break even, target profit, margin of safety, and target costing. Now, these concepts are not too difficult. The formulas are relatively straightforward. You will see how they're all sort of built on each other and interrelated. This is a topic that the CPA exam will test you on. It's not considered to be super difficult compared to some of the other topics you'll see. So pay close attention here, and we're going to go through the formulas quickly and then just focus on examples, because that's ultimately where we learn to apply this. And then I'll leave plenty of time for you to dive into the multiple choice questions, work on those, and watch the explanation videos, because again, practice makes perfect, and that's how you learn to apply this information. So starting with break-even point in units, well, this will tell us how many units the company needs to sell to offset their fixed costs, because fixed costs are there regardless of sales volume, right? And then we also have variable costs, which those are going to be part of contribution margin per unit. So if you recall, contribution margin per unit, that is calculated as sales price less all variable costs. So if we think about contribution margin per unit and total fixed costs, well, we have all the costs of the business. We're just separating them. So now we can understand how many units the company needs to sell to break even, meaning they offset all of their fixed costs. And why would a company want to understand their break-even point? Well, it helps them understand if they're going to generate a profit or generate a loss based on certain volume, right? So we have a company, let's say, that has a break-even point of 100 units. And then if they sell more than 100 units, that means that they'll generate a profit. If they sell less than 100 units, they will generate a loss. So for a company, from a forecasting perspective, trying to assess how many units they need to sell to break even, because they know their fixed costs or they've forecasted their fixed costs, that can help them determine, okay, is this a viable forecasting and budget plan, or are we going to need to think about something else? Because you'll come up with a break-even point and you'll determine, yes, that is achievable, or no, I don't think we'll get there. We might have to go back to the drawing board. Now, a company might say, okay, great, we know the break-even point in units. What if we want to know the break-even point in sales? And good news here is that it's only one little extra step, and this calculation is even easier. If we have the break-even point in units, right, that tells us how many units we need to sell. So then all we need to do is multiply by the selling price per unit, and that will tell us the total sales to break even. So we're going to need both pieces of information there, but oftentimes they won't give you the break-even point in units, so you would have to calculate that first. And remember, you can't just compare sales to fixed costs, because we would be excluding the variable costs, which were part of that contribution margin per unit. So that covers break-even point. But if you're a business owner, why do you want to break even? Right? Most business owners want to earn a profit. So we can take this one step further and look at how many sales units we need, or what a level of sales do we need to earn a target profit. So we have our target there. And the thing with profit is they could either tell it to you after-tax profit or pre-tax profit. So we have a two-step approach that helps you solve regardless of what they give you, right? So assuming they give you an after-tax profit, well, we would have to perform step one, where we take the desired after-tax profit and divide by 1 minus the tax rate. And that gives you the pre-tax profit. And then step two, this is similar to break-even point, except on the numerator, we're taking fixed costs plus that pre-tax profit. So that gives us the sum for the numerator. Then we divide by contribution margin per unit, and that tells us the sales units that the company needs to sell in order to offset their fixed costs and earn that pre-tax profit before applying a tax rate, right? And then if they wanted to talk about the sales dollars needed to earn that target profit, well, think back. All we need to do is multiply by the sales price, and that would give us the sales dollars. So I know we just cruised through several formulas here without an example, but that's because I wanted to wait to do them all together so that you could see how interrelated these are. So in our example, we have Sand Surf, a popular surf shop in a local beach town, right? We've all been to those local beach towns. We can picture that little surf shop, right? Some cool guys or gals that are leading all the lessons, and there's surfboards everywhere. Now, the company has the following information, right? A lot of per unit type stuff like selling price, direct material, direct labor, variable factory overhead, variable selling price, etc., right? Lots of information. What we're going to do is determine the break even in units, the break even in sales dollars, the break even to earn a pre-tax profit of $150,000, and then the break even to earn an after-tax profit of $120,000. So starting with task number 1, which was determine break even in units. Well, remember that formula, it's just fixed cost divided by contribution margin per unit. Now we don't have those specifically, so we're going to have to do some quick, easy calculations. So for total fixed costs, well, it tells us fixed factory overhead was $180,000 per year, and then fixed selling expenses were $60,000 per year. So total fixed cost is $240,000. And then for total variable cost per unit, well, we have the direct material per unit of $20, the direct labor per unit of $20, and then variable factory overhead is $4, and variable selling price per unit is $2. So that sums up to variable cost per unit of $46. The last thing we need to do is calculate the contribution margin per unit, and that's just the selling price minus the variable cost per unit, so $58 minus 46. That means the contribution margin per unit is $12. So now that we have the information, it's easy, right? We just take total fixed cost of $240,000, divide by $12 of a contribution margin per unit, and that means the break-even point in units is 20,000. That's how many they need to sell to offset the fixed cost. So 20,000 surfboards sounds like a lot, but we don't know how big this beach is and how busy it gets, so let's not pass any judgment yet. So like I said, we can take this one step further, and in task number 2, we're just going to determine break even in sales dollars. Well, if the break even point in units was 20,000 and it costs $58 per unit, well, we multiply those two, and that means that they're going to have to generate $1,160,000 worth of sales to offset not only the variable costs, but as well as those fixed costs. So that only gets them to break even, meaning there is no profit. But if we move on to task number 3, it says break even point to earn pre-tax profit of $150,000. Well, we don't have to factor in the tax rate here because it's pre-tax. And that pre-tax profit goes on the numerator along with fixed costs. So we just take $240,000 plus $150,000. On the numerator, we still have the denominator, which is that contribution margin per unit of $12. So $390,000 divided by $12. That means to earn that pre-tax profit of $150,000, they're now going to have to sell 32,500 surfboards or units. So again, to earn that pre-tax profit of $150,000, that is 32,500 surfboards. Again, seems like a lot. Maybe they're shipping these all over the world, right? They have a great direct-to-consumer business, and they're not just selling in this local beach town. We don't know, but there is how we solve task number 3. So let's take it one step further and go to task number 4, which is where we have to calculate the break-even point to earn an after-tax profit of $120,000 with a 20% tax rate. So our first step is to determine the pre-tax profit. So we just take that $120,000, divide by 1 minus 20%. So 120,000 divided by 80%. And that tells us the pre-tax profit needs to be 150,000. That's the same as task number 3, and that's what I wanted to illustrate. And then step number 2 would be the same. We get back to that 32,500 units, right? So it's more common that they will give you the after-tax profit because they want you to see if you can back into that pre-tax profit, and then it's quite simple from there. So that is break-even analysis and target profit. How many units do we need to sell, or how many sales dollars do we need to generate in order to either break even or earn a target profit? So relatively straightforward there, but think through this example as it does include all of the different aspects that you could see on this topic. So the next topic is going to be margin of safety. Right? And this really relates to how much breathing room do we have to cover our fixed costs, right? We just talked about break-even sales or break-even point, but based on our total level of current sales, what is our margin of safety in both dollars and as a percentage, meaning how much decline in sales could we have before we are below break-even and we start incurring a loss on the overall business, right? So this can give a company an idea of how much room they have and whether they need to start thinking about, hey, we should cut some costs. We might need to enter some new markets. It's really just a margin of safety and helping them feel comfortable about where the current business is. Now, there's two simple steps for this. If we need to calculate margin of safety in dollars, we would just take total sales, or they could tell you total current sales, but it's just going to be the actual sales or total sales minus break-even sales, which you may have to calculate, and that will give you the margin of safety in dollars. So really straightforward actual calculation there as long as you have the right information. Now we could take this one step further and express this as a percent. So we just take margin of safety in dollars and divide into total sales, and that gives us a percent. And as you'll see in this example, right, it basically shows you how much sales can decrease as a percentage before you hit that break-even point. So very important to understand the formulas, but we're going to learn how to interpret this right now. So as you can see in our example, it says that current sales are 100,000 and the break-even level of sales is 80,000. So what's the margin of safety in dollars and as a percentage? Well, in step one, for the margin of safety in dollars, we just take total sales or current sales of 100,000, subtract the break-even sales of 80,000, and that means the margin of safety in dollars is 20,000. So if sales were to go down $20,000, then they would be at that break-even point, which means they're not generating a profit or a loss, but they're at break-even. Now, if we want to express this as a ratio or percentage, well, we just take that margin of safety in dollars of 20,000, divide by total sales of 100,000, and that equals 20%. So how can we interpret this? Well, as the CEO says here in this little diagram or picture, it says if sales go down by more than 20%, the company will lose money. Right? So it can go down 20%, and that means we're at break even, but if it goes down, say, 25%, well, the company is going to be below break even in sales, right? And that means they're going to be generating negative income. That's a loss. That's not good, right? So again, margin of safety, overall, big picture, it can be used to assess how much cushion or how much breathing room do we have in this business before we start incurring a loss. Again, do we need to cut costs? Do we need to change some pricing? Do we need to go, add some products in different markets? Those are all strategic decisions, but that's why this is a helpful budgeting or forecasting technique. The last method here is called target costing. And instead of determining what the selling price needs to be, what we're going to do here is determine what the cost of a product or service needs to be in order to earn a desired profit. Right? So we can see the formula says planned selling price. Well, that is what the company plans to sell it for. Usually it would be dictated by existing prices in the market or what they think they can sell it for. And then we have to subtract out our desired profit because we don't want to, do all this work just to break even or lose money. We need to earn a profit. And what we're left with is the target cost. And that basically tells us what the company needs to produce the good or service for in order to earn that desired profit. If they're going to go below that, that's great. But if it's above that target cost, then there's probably no reason to actually enter this new product or service because you'll lose money on it. So let's go through an example because I understand conceptually this might be hard to understand. It's a newish topic. So it says that Sunsurf is developing a new type of surfboard. Similar surfboards in the market sell for $500. But Sunsurf plans to sell 2,000 surfboards at a price of $450. They require a profit margin of 30% on the surfboard. What is the target cost on this new type of surfboard? So if we look at the information we have versus our formula, well, the desired or planned selling price is going to be that $450. It's not the $500. For whatever reason, Sunsurf decided we're going to price our new surfboard just a little below the market price, which is going to end up being $450, right? So we have our planned selling price, that's $450. What we don't have is the desired profit in dollars. All we have is the desired profit margin of 30%. Well, if they plan to sell for $450, then all we need to do is say 30% of that needs to be our profit. So in step one, well, we can calculate the desired profit in dollars by just taking $450 times 30%. That means $135 of each unit needs to become the profit, right? So in step two, that target cost, now it's simple. It's just going to be that planned selling price of $450 minus the desired profit of $135. That means the target cost to produce and sell this surfboard will either have to be right at $315 or less. Otherwise, the company is not going to be able to earn that desired profit of $135. So if they're entering this new market, they're looking at, okay, here's what we can sell it for. Here's our desired profit. Here's the target cost. Can we build it for this amount? Or can we do better? Right? That's really why target costing is a popular technique for budgeting or forecasting, because it focuses on what the company can control. Right? They can't always necessarily dictate the selling price. That's dictated by the market. What they can control is the desired profit margin as well as potentially the target cost. And if they can't actually achieve that target cost, then they'll have to abandon this idea altogether or come up with a way to produce it cheaper, right? So that is the conceptual way to understand this topic. So that wraps up the module on cost, volume, profit analysis. We went through an example for each of these budgeting and forecasting techniques. Go practice the multiple choice questions. Think conceptually as you work through why would somebody want to calculate this and what does this really tell me? And that will help you remember this type of analysis. So when you see it on the exam, you have a step-by-step approach that you can just knock it out real quick and move on.